It's preparing for live stream. So anything you say will be in the public arena from now on.
Okay.
We'll go viral.
I thought that was fun the last time. The last time I did it, it was great because
Anything
all
you
the
say will
people.
be in the public.
We
So yeah, so you can actually go to the
oh yes,
YouTube and you can see it. You can see
gallery.
it
Ah, all the faces.
Okay, I may have to do a little bit of editing later just to make sure that you know, we kind of start from the session, and I'm just gonna share my screen and you know, start with the first few slides. Give me 1 second. But again, the slides are already online, so if you want to follow along, I can post the link on the chat window in a second, and you can follow along if you want to follow with the slides. The good thing is you can go back and forth with the slides. So QWAFAFEW, and then
Did you get that email about the Lindsay request?
Yes, I did. He's looking for West Texas or
Saudi Arabian light oil prices. The only place he thinks it might be is on a Bloomberg, but there's the university there. I guess because they're not doing any classes, they didn't turn their contract on. So.
Okay. So do you see the screen?
Yeah.
Perfect. So Hugh, whenever you're ready.
All right. So I guess I should kick it off. Okay, we have a few things going on at CFA Boston. October 21st is Women in Private Wealth Management. Also on October 21st is Climate Change Analysis Case Study, Mirova. On the 22nd is, October 22nd is GIPS Standards, Let's Talk About Carve-outs. And then on the 26th is the LIBOR to SOFR transition. And on November 10th is emotional IQ, the OLE approach to communicating with clients. And also November 10th is the using SASB standards to UN Sustainable Development Goals to improve into portfolios. And then November 11th is Introduction to Python for Business and Finance. Sri, do you have anything for Quant University?
Yeah, so we have kicked off our Quant University Fall School. So in the summer, we had 10 speaker series. Every week we had a speaker. We also are running 3 courses. So if anybody is interested in dipping their feet in the whole Python, machine learning, model risk world, this is a link they can go to, and they'll have some more details there.
Yeah, those were good, and they were free too.
Oh, thank you. So Dan, and by the way, all the slides and video and
let me introduce Dan.
code from the previous one, examples, Jared had shared, and also slides from Larry's session. They're all on Q Academy if you want to go back and revisit the last few QWAFAFEW sessions.
Okay. I'm going to introduce Dan. Mr. DiBartolomeo is president and founder of Northfield Information Services, based in Boston since 1986. Northfield develops quant models and financial markets. He sits on numerous boards, numerous industry organizations, including IAQF, CQA, and Boston QWAFAFEW. He's a director and past president of the Boston Economic Club. His publication record includes more than 40 books, chapters, and research journal articles, Dan has spent many years as a visiting professor at Brunel University and has been admitted as an expert witness in litigation matters regarding the investment management practice and derivatives and federal and state courts. At the beginning of 2018, he became one of the 2 editors for the Journal of Asset Management. So Dan, take it away.
Thank you.
So here, Dan, what I'm going to do is I'm going to make you the presenter so you can
Okay.
share your screen. Perfect. Now you can share your screen, Dan.
And how's that? Can everybody see what I'm
Not
seeing?
yet. Not
Yeah.
yet.
Not yet?
No.
Okay.
So you should click on the bottom green button, share screen in the bottom.
Yeah, I did. And let me try it again. Share. How about that?
Perfect.
Bingo.
Okay. All right, everybody. First of all, I want to make sure that everyone is observing QWAFAFEW traditions. I am here with my normal Myers rum, Coca-Cola, and lemon, and I provide a toast to all those participating this evening. Just before I start, a couple of quick comments. One, this is joint work with Chris Cantos. Chris is normally in my firm's London office, but he's actually visiting family in Minnesota tonight. I don't know if he's online at the moment, but if he is, he should certainly get as much credit for this work as I do. The other point is that this paper is forthcoming in the Journal of Asset Management. It will probably come out in the December issue, although I don't know if that has been fully determined at this time. The subject for tonight's presentation is called Pandemics, CAPM, and Factor Alpha. And it's really about the fact that the coronavirus pandemic has really reminded equity investors that extreme events do happen from time to time. They're rare, but some really strange things happen from time to time. And if we go back in the historical records, say to the 1880s, when financial markets as we know them really started, you can think of a couple of pandemics, you can think about world wars, you can think about the crash of 1929, but these events represent periods of both increased volatility and in some cases really negative returns. What I wanted to do in this presentation is really describe how we believe that such large events and the potential for such large events change traditional views of equity returns and factors and the kind of things that equity quants typically look at. Inside my firm, we often refer to this as volcano risk and sing a lot of Jimmy Buffett songs. He had one called the Volcano Song that seemed appropriate to this current situation. And what we've done really is rewritten CAPM in a way that we think captures this potential for large, rare events. And by doing that, what we conclude is that strategies that focus on alpha, which I'm going to describe as risk-adjusted return, as originally defined in a paper by Michael Jensen in 1968, are really materially superior to smart beta strategies that look for outperformance of an equity index based on active exposure to one or more known factors, but without explicit representation of the incremental risks. And I'm going to be using as a starting point one of our Northfield models, but then I'm going to change it around to illustrate how things change when we start to incorporate this issue of the potential for large, rare events. And there's some historical features that we really want to explain. The first one is the high equity risk premium. If you think about the historical record of equity returns, minus the risk-free rate, what we can get just for time value of money, a lot of economists have argued that the equity premium is surprisingly large. And this has led some economists and financial market commentators to argue that long-term investors should always be fully invested in equities. For example, Siegel had a book in 2014 called Stocks in the Long Run that argues that essentially long-term investors should always be fully invested in equities. The second thing we want to explain is that there's been widespread criticism of the most widely known, the most widely taught equity asset pricing model, the capital asset pricing model from Bill Sharpe, originally published in 1964. The argument is that the model doesn't seem to do a very good job describing equity asset returns, particularly the amount of return associated with so-called low beta stocks versus high beta stocks. The original model, as presented by Sharpe, doesn't seem to fit well with the empirical data. The third thing we want to explain is that there's a massive literature, hundreds of papers, on so-called factor anomalies that in some way describe persistent excess returns associated with some security attribute that's observable. And this is in some way a violation of basic efficient markets hypothesis from Fama in 1970. If markets are efficient, it shouldn't be that easy to observe which factors seem to produce better returns than others. And among the literally dozens of factors that have been purportedly researched in academic literature and practitioner literature are so-called value, momentum, size, and low volatility. And we want to be able to explain all of these in a model that seems to also make some intuitive sense. Importantly, I'm going to make a semantic distinction. I'm going to make a distinction about the wording of how the rest of the presentation is done and how the paper that's being published is defined. And that first distinction is the distinction between excess return and alpha. And at least the way we're going to talk about it, excess return represents outcomes that outperform some passive benchmark. So I did better than X index following some strategy. Whereas alpha, that terminology we're going to use to represent or describe outcomes that are in excess of some expectation, and that expectation in some way be associated with the expectation of risk. The second thing we're going to define for semantic purposes is whether we're talking about returns in a simple fashion or an orthogonalized fashion. And what I mean by that is that factor outcomes can be very complex because there are many factors that could influence the behavior of a portfolio. For example, we could think simply about the idea of a size factor as being the difference in return between a large cap portfolio and a small cap portfolio. However, those two portfolios are going to have a lot of other differences. The average PE is going to be different. The mixture of industry groups is going to be different. So we can't really be sure that that difference in return arises from size or some other effect that we haven't controlled for. Now, we can apply various statistical techniques to control for the fact that some of these variables are correlated, they influence each other. And so everything I'm going to talk about tonight is going to refer to orthogonalized values. So we're going to do the best we can to try and statistically isolate the returns associated with factors on a ceteris paribus basis. That is, whatever we ascribe to one factor has been statistically defined or estimated in a way that assumes all other factors are kept equal. So they shouldn't interfere with one another in the way these are estimated. So here, of course, is kind of the basic Bill Sharpe 1964 capital asset pricing model. One formula, not much here. On the left-hand side, we have the return of a particular security over a particular period of time. On the right-hand side, we have the risk-free rate representing the time value of money. We have the return premium on the market. So the market produces a return, at least in expectation, greater than the risk-free rate. There is beta as a scalar, where beta is an index of the covariance of a particular asset I to the market portfolio M. And then possibly ex post, there is some alpha. There's something left over. And that would represent the alpha for security I during period T. Now, that's kind of pretty much what everybody learns in first-year business school. It's what they teach in the CFA program. Now, there have been many different criticisms of the CAPM. And those studies have largely argued that there are many unrealistic assumptions built into Sharpe 64. The first is that it's a single period model. And that means that investors only care about what happens in the next time period, however long they define that to be, which means they're ignoring compounding, which if you're a long-term investor is probably a very important issue. Investors are assumed to borrow and lend at the risk-free rate. They can borrow or lend as much as they want. There's no limitations on leverage. We actually know what the market portfolio consists of. There are no transaction costs, no taxes, and that the beta values are actually known rather than estimated. The other part that comes really in the empirical literature is that the slope of the security market line, that is, how much extra return do we get or would we expect over one period as we go up in beta. And that slope of that security market line empirically seems to be much, much less steep than would be coming out of the theory and out of the formula that I've just presented to you. A lot of these critiques are summarized in a FAJ paper by Richard Grenold from 1992 called "Is Beta Dead?" Again, so this controversy about whether the capital asset pricing model works well or doesn't has been going around for a very long time. And I want to point out that the critiques are uniformly about expected returns, that whether or not the capital asset pricing model holds for asset pricing. It doesn't really talk, the critiques anyway, don't really address whether beta is a useful measure of risk. It's whether we have a useful measure of risk and investors ignore it. I think the most important thing about the capital asset pricing model, as written by Bill Sharpe in 1964, is that nobody's come up with anything better, at least anything that has been more widely accepted. If you go into a classroom in a finance course, if you go into business schools, if you go into the CFA program, this is what everybody's taught. Now, we've proposed historically a bunch of explanations of these of the flatter security market line, and I've posted a link to a presentation I did that describes some of this. And there's a whole bunch of these in the financial literature. Various authors covered in the linked presentation have proposed fixes, various analytical changes in the model, extensions of the model that cover things like the compounding of the single period assumption, the fact that we don't really know the market portfolio, the fact that there's the idea of guaranteed survival in a single period model. If an asset existed at the beginning of the period, it's assumed to exist at the end of the period, which we know doesn't really exist. And also the use of estimates rather than known values for beta. All of the fixes that have been proposed in the literature and by Northfield staff suggest a flatter security market line. And we've actually asserted that the security market line is not really a line at all, but it's actually a curve that curves downward past a particular critical value that we call beta star. And so the security market line is upward sloping for beta less than beta star, and it's downward sloping for beta greater than beta star. And that same mathematical construct is going to show up in an early paper by Bob Merton that I'm going to talk a little bit about soon. So here it is. Bob Merton had a paper in 1973 called the intertemporal capital asset pricing model. And it basically takes the Sharpe CAPM and adds a couple of terms to it. And basically those two terms, or the three terms that he adds, really address two issues. One is compounding, and the fact that compounding is impacted by volatility. Compounding is reduced by the square of volatility, so-called variance strain, and that in a multi-period world, investors may care about what today we would call drawdown risk and possible changes in the investment universe. The fact that whatever we think of as the market portfolio today, that same set of securities may be larger or smaller in the future and represent different opportunities. This is not a piece of the literature that is well known outside of academia, but it's certainly one that I think is important. The other one that I want to focus on that is very explicitly important for tonight is a paper by Fisher Black, where he proposes, from 1972, where he proposes a zero beta asset in place of the risk-free rate. In the original Sharpe CAPM, you have the risk-free rate plus the market premium times beta. Black proposes something a little different, where he says an asset could have zero beta because it is uncorrelated with the market portfolio. And since beta is an index of covariance, if the correlation is zero, that is sufficient to be beta zero without necessarily having zero volatility, which is something we would associate with the risk-free rate, the risk-free rate being something that we know at least for the next period. And so in the Black version of CAPM, the flatter security market line sort of arises naturally because you could think about some zero beta asset that could be very risky, very volatile, and yet have zero beta because its correlation to the market portfolio is zero or close to zero. I always use the example of somebody that's hidden gold bars under their bed. Gold prices move around a lot, but certainly aren't very correlated with the traditional financial markets. And in fact, in some empirical data are negatively correlated. So Black has proposed this idea of a zero beta asset that can in fact be risky in place of the risk-free rate. And I think that has a profound explanatory power in what is to come tonight. Now, one of the things we know is that the CAPM is derivable, mathematically derivable, from the MPT of Markowitz if you throw in the right assumptions. And the right assumptions basically cause beta to be the relevant measure of risk. But those assumptions include that security returns are really kind of a random walk, and therefore portfolio returns have the expectation of being normally distributed and serially uncorrelated, so-called IID. Now, if you look at empirical studies of equity returns, probably the best known long-term studies that go back into the 1800s are those of Dimson, Marsh, and Staunton. This idea that equity market returns are kind of IID is really refuted by a handful of very large events. At the global level, we can think about the world wars, the Spanish flu epidemic in 1918, the 1929 market crash, and the depression that followed. And now we've got, in recent years, the so-called global financial crisis and the current COVID-19 or coronavirus pandemic. So that's, maybe 6 really large events over, 100 years or maybe 120 years. There are also many, many examples of this same kind of financial collapse at the national level. Obviously, when the Tsarist regime in Russia fell in 1917, the communists took over, and the whatever financial markets existed at the time fell apart. There's still arguments about Tsarist Russia bonds floating around today, a century later. Germany in the 1930s during the Depression, China at the communist takeover in 1948, the Mexican peso crisis in 1982, Zimbabwe in 2008 when their local currency became effectively worthless. I still have a $1 trillion Zimbabwe bill in my wallet that I carry around, but I bought for $3.50 on eBay. It's turned out to be a good investment. Those are now trading for about $70. And also, you're seeing this kind of thing going on in Venezuela right now. Venezuela hasn't fallen apart completely the way Germany did in the 30s, but it's not in good shape. Now, one way to reconcile the CAPM with the existence, or the potential at least, for these rare large events is to think of the idea that whenever investors are long the equity market, they're short a lottery ticket where they sustain a random large loss every once in a while. Every once in a while, something big and bad happens. This is similar to the concept of catastrophe bonds in fixed income. In cat bonds, you essentially buy bonds, treasuries, but if a particular type of insurance, say hurricanes for Florida, has an event, and therefore there are a lot of insurance claims for property damage, essentially you lose your money. But in the meantime, you've made a very high yield because the insurance company is effectively renting your money to have extra reserves in the event of a large catastrophe. And so in some way, we're arguing that investors think about this. And these rare and random events are things that investors don't know if they'll come or when they'll come, if they come. And so the expectation of correlation between these lottery-like payoffs and the market is zero. And so the beta of this short position is 0. And there have been a couple of papers in the economics literature, one by Robert Barrow, one by Gabay, who was then at MIT, have argued that investors are very well aware of this. They're very well aware that these large, rare events can occur. And this is what explains the high equity risk premium relative to the risk-free rate. That investors argue, well, this might be the period when 1929 happens again. But what I think is most important for our mathematical formulation is that if this implicit catastrophe loss is built into an equity investor's market exposure, this qualifies as the 0 beta risky asset under the black version of the capital asset pricing model. So you've got this idea of, well, if I'm invested in equities, a bad thing could happen, and therefore I'm going to demand a certain amount of return for that bad thing happening. And that's where my return expectations have to start, not at the risk-free rate. The other thing is that you can think about this effect statistically. The expectation that rare large losses will occur occasionally, and unexpectedly, would mean that the distribution of equity market returns will have negative skew and positive excess kurtosis over any finite interval. If we think the next period might be the one in which the crash occurs, then obviously our expectation relative to some finite sample of the past will be that the future will have negative skew and positive excess kurtosis when I mix whatever has occurred in the past with whatever I think might happen in the future. So what I'm going to try and do is patch the capital asset pricing model a bit to account for these higher moments, to account for the fact that investors might worry that the next period will be the period in which something bad happens. And the usual approach to reconciling return distributions with higher moments when we would normally believe that those distributions would be, quote, normal, is really the method of Cornish and Fisher, which they first wrote in 1937. It was eventually published in 1938 in French. So not a huge number of people read this at the time. But basically, it's a mathematical technique that allows us to take a distribution of n moments and describe it as a distribution of n plus m moments and sort of do a best fit. So for example, if I had a distribution that had a mean, a standard deviation, a skew, and a kurtosis value, it was non-normal. These things were all significant. And I asked myself, what would be the mathematically or economically equivalent normal distribution? The Cornish-Fisher method gives us the math for doing that. So I can take this 4-moment distribution and say, what would be the most similar normal distribution in terms of the attributes of the distribution that I care about? And here I've given a simple example. If we have an asset with an 8% expected return and a volatility of 10, but then we assume there's a 6% chance that 1 in 6 in 100 that came out of our experience with world wars and large events of a 50% loss or 50% drawdown, the expected return drops from 8% to 5.2, and the volatility equivalent goes from 10% to 23%. And that 10 and 20, that 5.2 and 23 distribution would be essentially the closest fit with the 4-moment distribution having an 8% mean, a 10% volatility, but also skew and kurtosis. And so what we argue is that investors are going to demand additional return for that lost return and the increased risk arising from the potential for these higher moments to appear and be counted, at least in expectation. And that means that the amount of the equity risk premium that is not accounted for and needs to be accounted for by the slope of the security market line is now a lot less. So we're really saying if equities have outperformed T-bills, let's say on a long-term basis by 6% a year, a big chunk of that is coming from this kind of disaster aversion that investors have, and a smaller portion is arising from their concern about, what's the return on a 1.1 beta portfolio versus a 0.9 beta portfolio. That the security market line is going to be relatively flat because a big chunk of that equity risk premium is attributable to investor concern about these rare large events or drawdowns. And one of the things you need to do to make this sort of easily parameterizable is to understand how investor risk aversion might work. And so there's three components to this expectation of R0. What's our intercept? Where is our security market line starting? First is R sub F, the time value of money. The second is how much we've changed the mean because we've added these higher moments, right? That rare tail risk kind of event can occur. And the third is the idea that investors are going to demand more return if they perceive a particular market to be more volatile. In our example, the expectation of the incremental volatility is 23 minus 10 divided by 6, and 23 minus 10 being the difference in volatility, and the expectation of incremental return being that number divided by 6. The question is why is that scalar of 6 there? And that is explained in another presentation I made a few months ago. And I'm actually going to be covering some of that in my next webinar, which is October the 29th. But it turns out that this scalar of 6 fits a very broad range of events, both absolute risk, relative risk, and so you can think of it as kind of a way to define mean variance risk aversion, or lambda, based on the nature of a portfolio. Conservative investors hold conservative portfolios. Aggressive investors hold aggressive portfolios. And so if an investor thinks they have a conservative portfolio, but they actually don't, when they figure that out, they're going to demand additional return. And this scalar of 6 turns out to play a prominent role in that. Another way you can sort of rationalize this idea of incremental return for higher moments appeared in a paper by Kim, Harvey, and Siddique in 2000 that looks at the impact of what they call co-skewness, the fact that basically a lot of securities could all tank at the same time, creating a negative tail for the market as a whole. And in this paper, they think about how much a particular security contributes to the skewness of the market or broad portfolio. You could think about in the GFC, financial stocks were very impacted, but lots of other stocks weren't. If you thought about a market decline driven by the start of a war, some equities might be hurt a lot, while others might prosper, like defense contractors. And the current pandemic, obviously, airlines and hotels have been very negatively impacted, but tech firms and pharma companies have been doing extremely well. And in this paper, they go through a fairly complex empirical estimation, and they estimate that the effect of co-skewness, this potential for higher moments, adds about 3.6% to the market return. So out of the observed market risk premium of 5 or 6 or 7 or whatever you think it might be, they argue about 3.6 of this turns up as being related to this idea of co-skewness. And again, this is of the same order as what we had presented in the earlier example based on the method of Cornish and Fisher. The last thing we wanted to add into this model is bankruptcy risk. One of the ways you can think about co-skewness is, yeah, the market's going to tank if a lot of companies go bankrupt and cease to exist. And bankruptcies at the individual firm level are obviously more likely in periods of market stress. And so we want to make sure that we've captured that in some way. The original basic CAPM assumes that bankruptcies don't exist, that if a company existed at the start of the single period that is defined in the model, that asset still exists at the end. It may have had a negative return, but if you start the period, you end the period. There's another paper by Bob Merton, 1974, much more famous than the 73 paper, that basically shows that bankruptcy risk can be described as an option. Firms have, shareholders have the option to pay off a company's debts and own the assets of a firm outright. They also have a put option. They can essentially walk away from the assets of the firm and make lenders take over those assets in a bankruptcy proceeding. I had a paper in Journal of Investing in 2010 that shows how this asset volatility, which is the input to that option model, is really a measure. It can be estimated as the equity volatility, which is observable from the traded equity, adjusted for the firm's debt equity ratio. Divided is probably a wrong word there, but I can I'll actually fix that in the slides. But it's divided is probably the wrong way to describe that relationship, but it is closely related. And several studies have shown that the excess return associated with avoiding bankruptcy. So imagine the case where somehow I knew 25 or 30 years ago which companies would not go bankrupt, and I only invested in those. If I could do that, which I obviously can't in the real world, what it shows is excess returns around 3%. And there have been 3 studies of that type, and all of them come to something around that 3% figure. Now, what's important here is that if the propensity for bankruptcy, this idea of the option on the assets, is associated with the volatility of equity through the mathematical relationship involving the debt equity ratio, but the security market line is upward sloping, right? And we're going to show that in a minute. Then it must be true that idiosyncratic risk at the firm level must be associated with negative returns, right? If bankruptcies cause negative returns, but higher beta, higher covariance risk provides higher returns, then the incremental negative returns have to be coming from somewhere. And in the structure of the capital asset pricing model, the only place those negative returns can be coming from is idiosyncratic risk. And so this shows, this argues at least, that idiosyncratic risk is associated with negative returns, while the capital asset pricing model, as written in 1964, assumes that idiosyncratic risk diversifies away at the market level, and there is no return associated with idiosyncratic risk. So it's just a zero. It doesn't affect anything. And we assert that that is not the case. So to test this out, we basically first took a Northfield model, which we call the US fundamental model. Some people in the audience may be familiar with it in the sense that it's pretty much the same as it's always been going back to 1989. We haven't made any analytical changes to this model that would have affected the outcome of this analysis. It's basically US traded securities, which does include ADRs. So large companies traded in other companies would be included. And it basically uses the classic CAPM structure, but with that alpha term subdivided into 66 factor alphas. 11 of those are style factors like CAP and various financial ratios like debt equity or price to book. And there are 55 industry groups which are represented. The estimation of the model is weighted by square root of CAP, which affords a nice balance between the influence of few firms that are extremely large and more numerous small cap firms. There's also a passage in the original Grenold-Kahn textbook from 1995 that argues that this process also has some desirable statistical properties in producing estimators that are similar to a generalized least squares regression. If you think about idiosyncratic risk being negatively related to company size, then we would expect that goodness of fit would be better for large firms. And so we might want to use a generalized least squares regression. And by scaling the weights by square root of CAP, we get about the same outcomes as a GLS regression with a lot less complexity. One of the style factors in the 11 that I described a couple of bullets ago is a rescaled range measure of total volatility. Rescaled range measures are measures where we define volatility as coming from the range between the highest and lowest prices during a single period, rather than the standard deviation of returns over many periods. Obviously, if you have an asset like a stock, and over a week or a month, you look at the high price and the low price, and if those two things are close together, that thing is not very volatile. On the other hand, if it is very volatile, the high and the low will be far apart. And we're going to use that as kind of a proxy or a simplification of bankruptcy risk and this idea of Harvey and Siddique of contribution to the existence of higher moments. The idea that investors are worried about, big events that cause big drawdowns in the market. So this is just the Northfield model as originally written. It's just the CAPM with the alpha term broken out into 66 little pieces. And what I'm going to do is I'm going to move some of the pieces around, particularly the style factor that represents total volatility, which we're now going to use as a sort of a measure or proxy for bankruptcy risk. And I've replaced the risk-free rate with R0, which is this return to the zero beta asset, as defined in Black 72. And in this case, the R sub 0 has two components, the time value of money and some additional return that is associated with investor demand for compensation for potential severe drawdowns in the future caused by some event. I've color-coded a little bit of the formula. So the things that are in kind of bluish have an expected value of 0. So if you look at a particular security, the average of this volatility measure, which is the alpha vol sub vol dash t, is a z-score. It's so it has unit normality with mean 0. The expected value of the return associated with volatility is negative, as I described on the previous slide. The expected return on the slope of the security market line is in green, and our expectation is positive. And by mathematical construction, the expected value of beta is 1. On average, the beta of all members of the market have to average out to 1. And here we just did some quick empirical analysis where we took a basically 31-year history of the model and broke it down by beta ranges, simply looking at beta and saying, in reality, do high beta stocks produce lower returns or higher returns than low beta stocks? And what you observe through this analysis is that indeed the even accounting for all the other stuff, thus the slope of the security market line is positive. In the absence of other effects, high beta stocks produce more return than low beta stocks per period. Again, I'm ignoring compounding here. We have not gotten into the Merton 73 issue. But if you just look at the table, what you'll observe is the numbers for returns are higher in the top of the table than the lower part. And if you take that table apart, what you'll observe is that depending on whether you look at the portfolio cap weighted, equal weighted, square root of cap weighted, we get a security market line slope that is positive and around 1.6% per annum. That's positive, statistically significant, but far less than the 5 or 6 or 7% people would normally associate with the equity risk premium. If I pool the results for a cap-weighted portfolio and an equal-weighted portfolio, I get a slope for around 1.8 and a t-stat of 4. And what that means is if I take those away from the equity risk premium, the value of R sub H, that is, what is the return premium for rare large events associated with a beta 1 portfolio, it's about 4.7% per annum for this 31-year period. And, you know, not terribly different from the Harvey and Siddiqui estimate of 3.6 for skew only. The 4.7 number arises both from skew and kurtosis because we're capturing that in this Cornish-Fisher method. Now, if I look at the factor alpha to total volatility, which we're using as our bankruptcy proxy, in this rendition of the data, it comes out to be about negative 20 basis points a month. So if you just multiply that by 12, it comes out to about minus 2.5% a year, 2.4. And again, not terribly different from our 3% expectation if we were somehow able to eliminate bankruptcy risk altogether by somehow knowing with foreknowledge which securities would or would not go bankrupt in the future. Again, if we go back to that prior table and bifurcate the universe into just sort of high vol and low vol groups, you would get about a 3% return annually for bankruptcy avoidance, which again is consistent with our prior estimates. If we again look at the 31-year period, we can talk about and sort of confirm a lot of the literature on style factors, Fama French, and many, many, many factors. And what we find is, unsurprisingly, what's appeared in the literature before. That is a strong positive effect related to, quote, momentum, what technical analysts used to refer to as relative strength or some close variation thereof, and a combined alpha of 55 basis points per month for valuation factors. In this particular model, there are 4 different factors that have price in them somewhere, like a price earnings ratio. And if you do the arithmetic correctly and add everything up, the aggregate of the 4 factors where price is a component add up to an average of positive 55% per month. So looking at the sort of traditional way of thinking about this problem, we get what we've seen in the literature before, which is a strong positive return associated with momentum and a strong positive return associated with value investing, if you will. Now what I'm going to do is I'm going to rebuild the entire model. And I'm going to do this both for a 20-year period, so 239 months, not quite 20 years, and I'm going to do it also for the full 30 years and talk about the different subperiods. But for the 20 years from July of 2000 through May of 2020, we get some very different outcomes. And that we get, for example, a negative return to book to price. We get a much stronger positive return to PE ratios rather than book to price. We get statistically insignificant positive return to momentum or relative strength. And the most statistically significant return is a negative return to earnings variability. You might think of that in other parlance, other wording, as a positive return to quality, which again is something that is been used as a term in a lot of the academic literature. You also get a negative return to size. That is, small caps did well relative to large caps on a risk-adjusted basis over this period, not necessarily surprising. And importantly, we get a strong negative return to that rescaled range measure of price volatility, which, at least from a sort of discussion framework, we're treating the last line of this table as kind of the proxy for bankruptcy risk. And again, the observed value of 26 basis points a month negative is very much in line with our prior estimates of around negative 3% a year. If I start breaking out the alpha incomes for different periods, and I start including going back to 1990, we get similar effects. But what I wanted to focus on is that the alpha for the 4 valuation factors combined is no longer statistically significant. So if you include the whole 30 years and you include this idea that the security market line is flatter because investors are really worried about a market crash, then the returns to value investing don't look so good, and the returns to momentum investing don't look so good. But the return for low earnings variability, what you might think of as a high quality company, look very positive. Now, given that in the last decade, we've had 2 major events. We've had the global financial crisis, 2008, just sort of ended toward the end of the last decade. And then we've had the COVID-19 pandemic, the idea that companies with really steady earnings that are not likely to fall apart during bad times, that those companies did well, seems fairly intuitive, at least to me. And here I've just taken the two estimations and put them side by side for the decade of the 90s. For the decade of the 90s, again, remember, this is the period of the tech bubble. Lots of things were happening, but were very much related to a particular industry, the tech industry. Again, what we do see is under the traditional CAPM, a very, very strong return positive to momentum or relative strength. It's statistically significant. And when we adjust the model to reflect that big drawdown risk, the idea of R sub H, that investors care about big drawdowns, they're less worried about beta, then the factor return associated with momentum flips sign. It goes from very positive to slightly negative and statistically insignificant. If we look at the 2000s, again, we get a somewhat different picture. In this period, under the conventional measure, low PE, low earnings to price, was very positive under both schemes. And again, you had the tech bubble. So this is the period when stocks with 50 PEs and no earnings or infinite PE didn't do very well. And so low PE looks pretty good in this period, on both models. And high yield looks pretty good in this period. Again, the tech bubble caused companies with no yield to not seem particularly useful. And again, at the bottom, price volatility was strong and negative, no matter which model you use, the traditional CAPM or this revised CAPM with R sub 0 and R sub H as components. But again, what we get is volatility is not a good thing, at least during the 2000s, irrespective of how we formulate the problem. And then if we go to the 2010s, we get, again, a slightly different picture. This time, value investing doesn't look so good. Even under the conventional CAPM, earnings to price has a negative return, book to price has a negative return. Dividend yield is positive, but statistically insignificant. Momentum is positive, but statistically insignificant. But what does come through as significant under the new model are, again, low earnings variability is a good thing. High earnings variability is a bad thing. So quality seems to have held up during this period. And again, the very negative return associated with absolute price volatility, even though the return to beta, the slope of the security market line, is positive in both cases. So the only way that can work, if you look at the top line of the table and the bottom line, is that there is a large negative return associated with idiosyncratic risk. So I'm just going to wrap up. What we think this shows is that a somewhat more nuanced approach to asset pricing yields a, I think, intuitive result. That it seems that a large part of the equity risk premium is associated with rare but extreme events. Investors are aware of the '29 crash. They're aware of the global financial crisis. They're aware that wars happen and pandemics happen, and price that in to the way they look at equities relative to fixed income or holding cash. And since that's there, it means that the security market line, the return to beta that is off in the basic CAPM, assumed to be equivalent to the equity risk premium, is actually a lot smaller. That high beta stocks, at least one period of time, outperform low beta stocks, but the effect is small compared to what we've come to believe from learning the basic CAPM as Sharpe wrote it in 1964. An important part of this result is that we refute the idea that idiosyncratic risk has no return associated with it. In CAPM, the assumption is that all that matters is covariance. Idiosyncratic risk gets diversified away, so nobody cares about it and it's not priced. In this result, we find that it's a negative return. Maybe investors should price idiosyncratic risk by asking for even more return from securities that have high degrees of idiosyncratic risk, but they don't appear to. And so what we get is companies with high degrees of idiosyncratic risk seem to have high levels of bankruptcy risk, and the returns associated with total volatility and the returns associated with bankruptcy avoidance or bankruptcy experience seem to be of the same order. They seem to match very, very well. And so what does this tell us overall? It really says that smart beta strategies, the idea that I'm going to be fully invested and I'm going to have a loading on some factor, and I'm going to assume or believe that that factor is going to outperform some known benchmark, is really an overly simplistic way of thinking about this problem, and that in some way we need to think more carefully about the fact that investors aren't as dumb as we think they are. That in essence, investors in general are aware of the impact of large events, even though those events may be rare and the timing of those events may be unpredictable. They seem to play an important role in how equities are priced. And if our way of thinking about the problem is a better way, it's consistent with Black, it's consistent with Merton 73 and Merton 74, then we may have enough richness in the analysis to allow us to actually make good decisions about asset pricing and risk-adjusted returns in a way that is much richer than just saying, I'm going to go for low PE, or I'm going to go for low vol, or I'm going to go for some particular single factor. Because what we show here is that in this framework, relative to more common academic literature and practitioner literature, some of the factors that we presumed were very positive, like value and momentum, that managers frequently relied on, become insignificant and for some periods materially underperform. But there are other factors like quality that seem to have held up and been equally effective, equally successful on a risk-adjusted basis, either in the classic context or in the context of this more complex model. So I'll stop there. As I said, the paper is coming out in Journal of Asset Management sometime the next couple of months. If anybody doesn't want to wait, just email me and I'll send you a copy of the latest version. There's still a few changes to occur in the next couple of months, but thank you all for listening. I hope this was worth it, and I hope you will retire to the bar as we normally would in our standard circumstances. So here's a toast to all of you, and hopefully we'll all be together again, whether in person or virtually a month from now. Thank you and good night.
Thank you, Dan.
That's a very optimistic note, Dan, in a month.
Dan, if we found a factor that was consistently negative, wouldn't that be just as valuable as one that was positive?
Absolutely.
Yeah. So if you've got something here that's not any good anymore, then should we just be shorting it, or?
If you can, yeah. I mean, I mean, if you think about the empirical literature, there's a massive literature in low vol, but the low vol literature doesn't do a very good job.
Yeah.
I don't think, of drawing the distinction between, is low volatility arising out of low idiosyncratic risk, or is it arising out of low beta, or is it arising out of some combination of the two things being low?
Yeah.
And what this analysis suggests is that low beta on its own is not the answer. Low idiosyncratic risk on its own may be the answer. But certainly low beta, for the sake of low beta, at least in a single period world, is not necessarily beneficial. The slope of the security market line remains positive. Now, when you get into multi-period compounding, the Merton 73 version of CAPM, then at extreme levels of beta, if you think about, a portfolio with beta 3, you might get this effect where the compound returns actually start to go down because of variance strain. It's the reference in my slides to something called beta star. And if you go past that critical point, then the expectation of the geometric rate of return actually declines with beta, but the expectation of the arithmetic single period return continues to rise. So it's a straight line if you're only thinking about what's going to happen in the next period. But when you think about compounding over many periods, really high volatility portfolios, really high beta portfolios are typically not good performers. And if you go back through all the stuff that Dick Michaud wrote, I think in the second version of his book, he actually, comments on this, that there appears to be some sort of point where once you get past that level of portfolio volatility, returns start to go down rather than up.
Now, I mean, just to follow up, so idiosyncratic risk to me is like whatever left over is not explainable. So you can't say idiosyncratic risk is a factor, is it? I mean,
well, I'm not saying it's a factor. What
right,
what we're using in the model is observed total volatility, right? Is the high price and the low price in the historic range far apart?
Okay.
The return for that is persistently negative. And if you believe in CAPM and you also believe that the return to beta is positive, then because in the CAPM total volatility arises as a combination of beta risk and idiosyncratic risk, the only way that those two things can mathematically reconcile is that the return to idiosyncratic risk is highly negative.
But it's not something you could short.
No. But you can short total vol. Imagine, look at something like a gold mining stock. Has very little correlation with the market.
Right.
So its beta is low.
Yeah.
But its idiosyncratic risk is high because gold prices go up and down like a yo-yo.
Right.
And in this empirical data suggests that that's a bad thing to invest in. You want beta, but you want low idiosyncratic risk. So something like a gold stock is the wrong way around, right? It's low beta, high idiosyncratic, which at least in this data suggests is the worst thing to invest in.
Right. So is it diversifiable?
It is diversifiable. The question at the portfolio level, the question, and that's why Sharpe argues investors shouldn't care. There shouldn't be returns associated with it.
Okay, that's what I was trying to get.
The point is, the historic that at least this data suggests that high total vol is bad, high beta is good, And the only way those things can be arithmetically reconciled in the context of the capital asset pricing model is you've got to have a negative return associated with idiosyncratic risk at the individual security level. Whether that individual idiosyncratic risk is or is not diversified away at the portfolio or market level doesn't seem to matter. Investors seem to be pricing or behaving in a way that says, I don't like I'm not willing to take idiosyncratic risk. And for securities that have high degrees of idiosyncratic risk, I'm not going to participate in those, so they're going to have low returns.
Okay.
Dan, it seems to me like there are two ways that you could approach this beta zero asset. One is to assume that the returns of this beta zero asset are higher. The other is to assume the risk premium is lower. Having done a fair amount of work with Jake Thomas back in 98, 99, 2000, he takes that latter approach. Conceptually, are you just going to get to the same place?
Well, I'm saying that, if you think about how people have written in the empirical literature,
Yep.
The way Sharpe describes it in 64 is the equity risk premium, right? Market return minus the risk-free rate is what gets multiplied by beta and expectation. Now, there's certainly an argument, and which I make in one of the presentations I cited, that we don't actually know what the market portfolio is.
Right.
Is it just equities? Is it equities in junk bonds? Is it equities and a bunch of other stuff? Do we include fixed income?
Yep, I agree with all that. Yep.
Yeah. So you can certainly argue that a security market line being flatter can be explained by a different description of what the market portfolio consists of. Mm-hmm. And again, if you go through the presentation I had a link to, that's covered in there. I recall a presentation by a guy named Bob Furman, who used to be the sort of fixed income quant at Lehman, and before that, Barra, where he made the point that because of securitizations in fixed income, a lot of fixed income indices count the same debt multiple times.
Right.
So the security market line or the definition of the market portfolio is very squishy. I mean, if you read Sharpe 64, he says there is this thing called the market that involves all risky assets. Mm-hmm. But again, is it only liquid assets? Is it stuff that's traded on exchanges? And or does it include, brick and mortar real estate that somebody would own as a landlord? Depending on what you define as the market, you're going to get a different empirical result. Right. For the purposes of this presentation, I'm assuming, as most people do, that you define beta relative to an equity index. And that equity index should be broad. The only thing that we do here that is a little out of the ordinary is that beta in this work is defined relative to an equity index which is square root of cap weighted rather than cap weighted.
Right.
And we did that very specifically because in having a model with many factors, you want to have a large sample size. And if you cap weight, the number of independent observations you actually have is quite small because the capitalization of the US market or the world market is dominated by a few very, very large companies. You've got now today a few enterprises, with $1 trillion market caps. It takes a lot of micro cap stocks to make up for that.
Understood. I think the work that I did with Thomas back in the turn of the millennium was just that the co-skewness between the in-country risk-free asset and the equity market tends to dominate when you get a country-level default like Germany, Russia, Venezuela, Mexico.
Absolutely.
And so that both go to zero. And so that it makes more sense to bring down the equity risk premium than to bring up the very theoretical zero beta, not risk-free asset, but zero beta asset.
Well, again, what I'm doing here is I'm saying there is the time value of money, that's real.
Yep.
And there is the equity risk premium, which is observable. And depending on
observable when there's not co-skewness at the limit.
Right, but there's a premium that is historically observed for whatever you think the market portfolio is. And, you've got in the original capital asset pricing model, it says that's the thing that beta should act on. In this model, we're saying, no, beta should act on a subset of that. Mm-hmm. And effectively, the point you're making is that the piece that, could be big, and I agree with you that it's big, is the investors demanding a return for the 1931 Germanys of the world, the Zimbabwe's of 2008, where the bottom falls out. China 1948, the communists show up and the Chinese market goes to zero because it's not a thing anymore. I totally agree with that. So it's really just a question of how you lay out the algebra, but even in the context of that thing is big, right? That return associated with extreme events, collapse of countries is big. What we came out with here is that the slope of the security market line is still positive and significant. So it's smaller than the way it's written in Sharpe 64, but it's still positive and significant. And the only way to reconcile that with the observation that low vol seems to be a thing is that people understand that diversification has limits. If the market collapses, doesn't matter how diversified you are, right? I can own all 1,000 stocks or whatever, 2,000. If the market goes to zero because the world collapses, or, the Earth is hit by an asteroid, diversification fails. And so people worry about that. And, we think this seems to fit the data reasonably well.
Isn't the whole kinked covariance matrix that the AQR folks have been pushing as the reason for the low volatility effect across, fixed income, foreign exchange, all that kind of stuff?
It could be, I mean, I don't disagree with any of that, but certainly what, if you go back to, Merton 73, the idea that investors care about compounding seems pretty straightforward. And it would seem, from the empirical data that the idea that companies do go bankrupt and it matters if you try and avoid that matters.
Yeah.
So, I mean, I think the bottom line is, and what I tried to present in this paper was really quant equity managers spend a lot of time thinking about sort of factor returns. Should I tilt toward value? Should I tilt toward momentum? Should I do this or that? Mm-hmm. And if you look at those in a very simple way, which is, did I beat the benchmark? I get a certain set of answers. This factor was good over this time period. And in different time periods, maybe the results were different. If I do it, CAPM style and say, all right, well, this is the way things should work. Let's see how things vary from that expectation. I get a different set of answers. And what we're trying to do here is sort of say, well, the CAPM view has been heavily criticized for not being realistic in a lot of ways. Let's try and make it a little more realistic and see what we get. And what we get is that a lot of the simple ideas of factor investing, like, yeah, we should load on momentum, we should load on value, don't look that great anymore. And that other things that, have come up, there's certainly plenty of literature about, quote, quality effects, do come through. And, that's really all this is trying to do. But I think it seems pretty strong. Doesn't change risk numbers very much.
Right.
We rewrote our risk model to capture this. Doesn't change a lot. But what it does do is it says the returns associated with some factors do look a lot different when you account for really big events.
How is this conceptually different from a long-winded explanation of the Merton model, right?
I think
the investors have written a big put.
Fair enough. I think it's it's different in the sense that Merton, when he wrote it, said some really important stuff. That investors are sensitive to drawdowns and they care about multiple periods. Totally agree. I think what's different here is, and this is not a criticism of Bob because he's writing this in 1973, is, we've now got 37 years of history subsequent history of how 47 years of how we interpret factor loadings and the returns to factor loadings. And all I'm trying to do is say we really need to think about this in a little bit richer and more careful way, because when we do, I think you get something that's intuitive, and I think you get something that is different than invest in momentum and value, because under this framework, momentum and value don't look all that great. They're not bad, but they're not the panacea that carried quant equity managers for many years that may not have been a panacea.
It seems like Merton holds if you assume constant bankruptcy risk, which
I don't disagree with that at all. And what Bob did, and when I sent this paper to Zvi Bodhi, the first thing he said was talk more about Merton 73. He's right. And so if you actually see the text of the latest version, it does address this reasonably thoroughly. But I think, for a practitioner, the message is pretty simple, which is, the literature of, invest in value, invest in momentum, and you're okay, looks a lot less sound in a world where there is a material probability of some really bad things happening. Now, really bad things are rare, but I pay a lot of attention to them because personally, as a young guy in my 20s, I actually lived on an island that had a live volcano, and you got up every morning and you looked and you saw whether there was ash on the ground, and it was very much up close and personal as to whether you were going to make it through the day on the island. Investors care about that, and we should recognize it in the way we think about modeling.
So as a quantitative investor, really, you should caveat everything by, first of all, stating your view on the direction of interest rates and the direction of volatility.
Yeah, I mean, I'm not arguing. All I'm saying.
No, that's probably the right answer.
Yeah, I mean, the bottom line is, when I got up in the morning on the island of Montserrat in 1987 or 86,
No.
And, you looked up at the volcano and said, okay, nothing's coming down at us. We're probably going to make it through the day. You cared. But I'll tell you this, it changed people's behavior. It changed the way you went to a bar. It changed the way you went to a party. It changed how often you went to church on Sunday. Because
it certainly changed your children's inheritance if you had a lot of real estate.
Exactly. And it also changed, for example, the way people built houses.
Yeah.
You didn't build, gigantic mansions, even if you can afford it, because you knew one bad day with the volcano and gone. That island is large, 75% destroyed and under 6 feet of ash, and a tiny population still exists there. But, investors aren't as dumb as we think. And they know that even rare things do happen. They remember stories from their grandparents about the Great Depression and the 29 crash and the this and the that. And it's built in. And we ought to recognize that in some way. And unfortunately, when CAPM is taught, it's taught the simple, Sharpe way. And CAPM is an enormous achievement. But the more nuanced ideas of Merton and Black never get taught because, maybe it takes up too much class time. But I think it should be, because I think in some ways that's the way the real world works, or at least it's closer to the way the real world works. Are we done? You, Sri?
Are there any more questions?
Thank you, Dan. That was a very interesting talk as always.
Yeah.
My pleasure.
Thank you, Dan.
All right, everybody drink up, please.
All right.
Good to see you, Dan.
Good night.
Have a good
Hi,
night.
guys.
And we'll mail out these, the links to the YouTube or whatever.
Yeah, so I'll send you an email. I put it on the chat window too, but I'll send you an email and you can mail that out.
Okay.
Thank you all. Have a good night. Be safe.
All right. Thank you. Thanks, Dan.